Why Bond King said there is no way the Fed is going to 5%. TLT, an inverted yield curve, knows the Fed is bluffing and wrong again. 2023 is starting off the same way as 2022. Except this year, instead of the all-time high, it's the lower high. The Dow's all-time closing high was a year ago. Those early January 2022 highs have stood until now, which leaves the only question on the table. Is this Friday's high marking the high of the year for 2023? From the Fed minutes, we absolutely do not want financial conditions to loosen. In fact, we need them to tighten, and we are worried about the market is fighting us. Market on Friday. Hooray! All the major stock market indexes are up at least 2%. Drastically loosens financial conditions. I guess it'll be fighting the Fed until the very end. Maybe there is a good reason for it. The Fed got inflation wrong in 2021. Said it was transitory when it was at 5% during the summer of 2021. Now we are in 2023. They are still fighting inflation. Said they are going to keep raising another 75 basis points until it's over 5%. Why Bond King said there is no way the Fed is going to 5%. Why TLT and inverted yield curve know the Fed is bluffing and wrong again. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Another hopium rally. The S&P 500 is up 2.38%. Today at the top of a sideways channel that started mid-December. Both the S&P and NASDAQ are in 3-week consolidation channels, having stabilized for now. The dashed lines reflect support levels. The S&P 500 is just above support. There is, at the 3,200 level, stronger support at the 2,400 level. There is no fundamental or technical reason to believe current support will hold. Ultimately, I expect a decline to 2,400 level. A decline to the 1,800 level is not at all out of the question. Amusingly, Friday's rally is smack in the face of a Fed warning about the markets getting the Fed's resolve wrong. The hopiest believe the Fed will pivot. It does, and I think that's likely. It will not be as much as the market expects, and it will be because the Fed broke something. Neither of those conditions rate to be good for the markets. But the Fed has trained the markets to act like Pavlov's dogs. So that is exactly what's happening on weak data reports. Investors appeared to latch onto slowing wage growth for American workers as the Fed has been aggressively working to pull down inflationary pressures. Average hourly earnings rose by 0.3%, less than the 0.4% consensus estimate. Also, the unemployment rate fell to a 50-year low of 3.5%. Last time we had a 3.5%, it wasn't long till we get that March 2020 crash. The Fed knows that there's still a lot more work to be done. They're going to have to stick to that script because the bond market shows yields going down. That puts them away from their tightening. That puts them away from their objective. We still have a lot more price declines to see before we can comfortably say mission accomplished. Lower bond yields suggest traders expect the Fed to start cutting rates in 2023 in the face of a recession. The ISM report on Friday showed services activity, a key engine of the U.S. economy, contracted for the first time since May 2020. The 2-year, 5-year, and 10-year Treasury yields each dropped on Friday as bond prices rose. Minutes from the Fed's meeting in December showed no policymakers expect to cut rates in 2023. On the inflation front, investors will get their next look at consumer prices on January 12th with the CPI report for December. How bad is bad enough? Are we really going to own nothing? The experts on television are endlessly debating about whether or not we are going to have a recession this year. And meanwhile, economic activity is imploding all around us. The number of homes being sold in this country each month has already fallen by a third. The number of job cuts in November was 417% higher than it was during the same month a year earlier. And at this point, even almighty Amazon is laying off 18,000 workers. After everything that has already transpired, everyone should be able to clearly understand what is happening. So many people have been waiting for an economic nightmare to come. But the truth is, it is already here. Here is 5 reasons why the Fed can't get to 5%. Number 1. U.S. manufacturing is declining at the fastest pace that we have ever seen since the early days of the 2020 lockdown. The S&P 500 Global U.S. Manufacturing Purchasing Managers Index, PMI, fell at the fastest rate since May 2020 in December, a continuing sign that the manufacturing sector is on the decline. The U.S. manufacturing PMI posted a 46.2 in December, down from 47.7 in November, and solidly below 50, which signals that the sector is contracting. Production levels contracted in back-to-back months, with new sales plummeting at the end of December, at the fastest pace since 2007, as companies cited weakening demand amid economic uncertainty and inflation weighing on consumers. Number 2, U.S. services PMI has now fallen for 6 months in a row. Number 3, we just witnessed the largest one-day drop in the Baltic Dry Index since 1984. The Baltic Exchange's dry bulk sea freight index crashed on Tuesday in the worst decline on record, sinking on prospects of a global recession. Baltic Dry Good Index is a measure of global shipping and economic health. The overall index, which tracks rates for Capesize, Panamax, and Supramax shipping vessels carrying dry bulk commodities, plunged 17.5% to $1,250, the most significant daily decline since 1984. Number 4, Thanks to rapidly falling imports, we just witnessed the largest monthly decline in the trade deficit since the last financial crisis. Remarkably, the 20% one-month decline in the deficit was the single biggest drop in the U.S. trade deficit on a percentage basis, going back to the global financial crisis. Number 5, in 2022, U.S. auto sales were the lowest that we have seen for a full year in more than a decade. Industry-wide, U.S. auto sales totaled 13.7 million vehicles in 2022, the lowest figure since 2011, and an 8% decrease from the prior year. Sales had topped 17 million vehicles for 5 straight years before the lockdown struck in 2020. Unleashing supply chain problems that have bogged down deliveries ever since. The reason is high interest rates. Even the people with the highest credit score need to pay 8% plus on a car loan now. Who's going to buy a new car? The Fed were able to keep the party going for a long time by absolutely flooding the system with money. But now they have lost control. The highest yield on the U.S. Treasury curve is the 6-month T-bill at 4.8%. There is no way the Fed is going to 5%. The Fed is not in control. The bond market is in control. We are literally careening toward disaster, but most Americans still don't understand what is taking place. Most Americans just assume those in authority know exactly what they are doing, and that return to normal is inevitable. I wish that was true, because the ride into the economic abyss that we are facing is not going to be fun. This is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an awesome book. And my book, Rainbow Focus, another amazing book. Place your order today, order your copy, and if you leave a review and order a copy before January 30th, you just need to leave a review and then message me. You will get 50% off of one of my author packages. So you just have to purchase a book, leave a review, and then message me saying that which book you purchased and that you've left a review, and then I will give you the 50% discount on whatever package you choose to become an author with me. You are such a good boy for watching my video right till the end. Bye.